Welcome to Thoughts on the Market. I'm James Lord, Morgan Stanley's head of FX and EM strategy.
And I'm Simon Waever, global head of EM Sovereign Credit Strategy.
And on this special episode of the podcast, we'll be discussing our 2023 outlook for global emerging markets and fixed income assets and what investors should pay close attention to next year.
It's Monday, December 12th at 11 a.m. in New York.
A big theme from Morgan Stanley's year-ahead outlook is the outperformance we're expecting to see from emerging markets. This isn't just about emerging market fixed income, though, which is what Simon and I focus on, but also equities. So across the board, we're expecting much brighter days ahead for EM assets.
And of course, the dollar is always key, and it has been extremely strong this year. But what about next year? What do you think?
Yeah, so we are expecting the dollar to head down over 2023. In fact, it's already losing ground against a variety of G10 and EM currencies, and we're expecting this process to continue. So why do we think that? Well, there are a few key reasons. First, US CPI should fall significantly over the next 12 months. This is because economic growth should slow as the rate hikes delivered this year by the US Fed begin to bite. Supply chains are also finally normalizing as the world is getting back to normal following the pandemic. This should also help the Fed to stop hiking rates. And this has been a big reason for the dollar's rally this year.
Right. So that's in the US. But what about the rest of the world? And what about China specifically?
Yeah, so inflation is expected to fall across the whole world as well, and that is going to be a stepping stone towards a global economic recovery. Global economic recovery is usually something that helps to push the dollar down, so this is something that will be very helpful for our call. And third, we see growth outside of the US doing better than the US itself. This is something that will be led by China and other emerging markets. China is moving away from its zero COVID strategy, and as they do so over the coming quarters, economic activity should rebound, benefiting a whole range of different economies, emerging markets included. So all of that points us in the direction of US dollar weakness and EM currency strength over 2023. Simon, how does EM look from your part of the world?
Right. So away from FX, the main way to invest in EM fixed income are sovereign bonds, and they can be either in local currency or hard currency. And the hard currency bond asset class is also known as EM sovereign credit. And these are bonds denominated in US dollar or euro. We think sovereign credit will do very well in 2023, and we kept our bullish view that we've had since August. I would say external drivers were key this year in explaining why the asset class was down 27% at its worst. So that included hawkish global central banks, higher US real yields, wider US credit spreads, and a stronger dollar. We think the same external factors will be key next year, but now they're going to be much more supportive as a lot of them reverses.
What about fundamentals, Simon? How are they looking in emerging markets?
Right, they do deserve a lot of focus themselves as well, because after all, debt is very high across EM, far from all have access to financing, and growth is not what it used to be. But they're also very dispersed across countries. For instance, you have the investment grade countries that, despite not growing as high as they used to, still have resilient credit profiles and only smaller external imbalances this time around. Then you have the oil exporters that clearly benefit from higher oil prices. Of course, there are issues in particularly those countries that have borrowed a lot in dollars, but now have lost market access due to the very high costs. Some have in fact already defaulted, but on the other hand, a lot are also being helped by the IMF. And if we look ahead to 2023, there are actually not that many debt maturities for the riskiest countries.
And what about valuations, Simon? Is the asset class still cheap?
Yeah, I would say the asset class is still cheap despite the recent rebound, and that's both outright and versus other credit asset classes. We also see positioning as light, which is a result of the significant outflows from EM this year and investors having moved into safer and higher rated countries. So putting all that together leaves us projecting tighter EM sovereign credit spreads and for the asset class to outperform within global bonds. And that includes versus US corporate credit and US treasuries. Within the asset class, we also expect high yield to outperform investment grade. But that's it for the hard currency bonds. What about the local currency ones?
Local currency denominated bonds could be a great way to position in emerging markets because you get both the currency and currency exposure, as well as the potential for bond prices to actually rise too. The bonds that you were just talking about, Simon, are mostly dollar denominated, so you don't get that currency kicker. So not only do we think EM currencies should rally against the US dollar, but yields should also come lower too as inflation drops in emerging markets and central banks start cutting interest rates over the course of 2023 and do so much earlier than central banks in developed economies. We've also seen very little in the way of inflows into this part of the asset class over the past 5 years or so. So if the outlook improves, we could start seeing asset allocators taking another look, resulting in larger inflows over 2023. Simon, thanks very much for taking the time to talk.
Great speaking with you, James.
As a reminder, if you enjoy Thoughts on the Market, please take a moment to rate and review us on Apple Podcast app. It helps more people to find the show.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.